Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Everybody, thanks for joining us again today. Again, we are looking at all the banks this quarter, all the big banks. We've already reported on Citigroup, JP Morgan, Bank of America. And today we're going to be talking about Wells Fargo. Now, Wells Fargo, for the last number of quarters, they've been overly transparent, in my opinion. They have almost exceeded expectations with how much they disclose, and to a certain extent that works to their detriment, because if you disclose so much, eventually someone's going to find something to pick holes in. So that happened again. They missed on a reported basis. They reported EPS of 98 cents versus an estimate of 112. If you adjust out one-time items, my estimate is more about $1.08. There's just a number of moving parts in this quarter. They had a mortgage servicing rights valuation increase of $345 million quarter over quarter, which equated to about 4 cents a share. Interestingly, that was a huge reason for the poor earnings quality last quarter when they actually increased the valuation of their mortgage servicing rights, $1.33 billion. Now, this is a bigger deal for Wells Fargo than for some of the other banks because mortgage is such a larger portion of the Wells Fargo portfolio. Again, if the interest rates increases, it also increases the extension on the mortgages, which is actually a good thing for mortgage servicing rights because it means you're going to be able to service that mortgage for even longer. If interest rates are decreasing, then you have those refinances coming in, which increases the prepayment rate, which shortens the life of the mortgage and decreases the value, the terminal value, or the length of time you're getting this mortgage servicing right income stream. So that's why they had the valuation increase, because interest rates rose this quarter. They also had one-time discrete tax expense of $419 million. They had some non-litigation expenses, $619. They had a gain on sale. They had an impairment. They had a reserve release. So there were just a number of moving parts this quarter. Revenue slightly missed expectations, but when you're talking about revenue for a bank, you can kind of say that's broadly in line. Net interest margin actually beat expectations significantly. They reported 2.93%. The estimate was 2.86%. But let's actually dive into some of what actually drives the Wells Fargo stock. When we're talking about that, right now, everything comes down to the efficiency ratio. Everything comes down to the efficiency ratio. Wells Fargo has these targets for 2020. They want to reduce expenses by $4 billion. They want to take the efficiency ratio down back to where it was even just last year, into the high 50s. And we're starting to see some of those expense reductions bear fruit. For once, they were actually able to reiterate their expense reduction target for the year of $53.5 to $54.5 billion. And I really think that this is the biggest factor influencing the stock right now. On the negative side, they are battling on a number of fronts. The first and most obvious is going to be the increased competition in originating mortgages. When people are signing mortgages and doing that, a lot of times it just becomes far more competitive. And when it becomes competitive, you make less money on it. And that's exactly what's happening to Wells Fargo. So when you originate a mortgage, you basically collect a fee based on the value of the mortgage. And right now, that fee, net of expenses, is only about 0.77%. And importantly, Wells Fargo does not expect that to improve anytime soon. If we look at how it was last quarter, it was 0.94%. So competition has clearly picked up. On the positive side, though, they are beginning to, after the whole account scandal from about a year and a half ago now, they are appearing to actually accelerate those originations. They should be able to actually begin to grow originations in auto on a year-over-year basis this quarter. And they're starting to build that business again. Now, right now, and even next quarter, the originations might not compensate for overall attrition in the existing loan book. So as loans continue to roll off, they need to originate more to compensate for those loans, especially on the home equity space. That was a huge deal for Wells Fargo in the day. So that is what Wells Fargo is battling right now, is that although they're starting to see an acceleration in a lot of these originations, it's not able to compensate enough for the declining legacy book of business. I would expect that to start to switch over sometime in the first half of 2019, but it could take till the second half of 2019, in my opinion. On the digital side, they continue to press forward with that. The digital mortgage application tool is now accounting for about 23% of all retail mortgage applications. And the credit card purchase volume was strong. It was up 7% year over year. Debit card purchase volume was up 9% year over year. And like Bank of America, they only saw their deposit rate go up 6 basis points quarter over quarter. This is extremely important because it means that people are not fleeing Wells Fargo in terms of deposits. In fact, Wells Fargo's deposit beta is actually lower than Bank of America's, which is kind of interesting considering the hot water that Wells Fargo is in. You'd think if someone was looking to change a bank, it would be a Wells Fargo customer. But that wasn't the case that we saw in the quarter. Over the longer term, over the next 2-3 years, Wells Fargo does continue to intend to bring down its capital ratios from about 12% to 10%. And they will do this by repurchasing stock and paying their dividend. And right now, their dividend was just raised significantly. They're going to buy back a good chunk of stock this year. And importantly, what I like to see here is because when we saw the Fed approve the ask, so the Fed has to go ahead and approve the ask when these banks want to actually buy back stock or make dividends. And the Fed approved that. Now, that's significant not just because that's money returning to the shareholder, but it's also significant because Wells Fargo is, of course, in hot water with the Fed and is, in fact, not allowed to expand its asset base until things improve at Wells Fargo operationally. So the fact that the Fed actually approved them for a significant share buyback and dividend plan is some confident that allows us to have some confidence that they're not going to be vindictive about Wells Fargo and just try to keep pressure on Wells Fargo stock. So keep an eye on continued talk between the Fed and Wells Fargo. Wells Fargo is adamant that the Fed is not really affecting, and the asset cap is not affecting what they're able to do on a loan origination basis. But it would be a headache lifted off the stock if we were to have some resolution there. But again, don't expect that until certainly later this year and probably into 2019 as well. So Wells Fargo remains to be a turnaround story. I think that they are doing some of the right things, but it's going to take a while. They need to bring that efficiency ratio down. They need to bring those expense ratios down, and they need to hit that turning point where originations are compensating for the roll-off in the loan book. Thanks.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.